Now the topic before us is exploring the residents of the foreign exchange market. We all know that New York Stock Exchange, London Stock Exchange, Bombay Stock Exchange, all these stock exchanges where buying and selling of stocks or shares takes place have a specific physical building. But in the case of forex market, foreign exchange market, this is not the specific case where we can say that this is the specific building or specific office of the forex market, and this is the single office all over the world. We cannot say that. In the case of New York Stock Exchange, there is a specific office or specific building which is called this is the Stock Exchange of New York. In the case of forex market, a large number of banks, investment firms, individual traders are involved, and they are scattered all over the world. They and the all the buying and selling takes place between buyer and sellers through these intermediaries in the form of banks or investment firms. This forex market is a decentralized marketplace, not confined to a single building or single specific location. We will understand the same now in detail. The forex market does not have a specific physical location. It operates in a decentralized manner. It means that it is not confined to a single building or exchange floor. Forex market is in contrast to traditional stock exchanges like New York Stock Exchange, London Stock Exchange, which have specific physical locations. The global foreign exchange market is a vast network of participants. Who are the participants? Participants are commercial banks, central banks, investment firms, foreign exchange brokers, individual traders, etc. All these participants engage in buying and selling of currencies for various purposes. The purposes may be different because an individual may desire to purchase the foreign currency for, say, travel purpose. If he wants to visit, say, another country, he will want the currency of that country. An importer may desire the currency of export, where from here he is importing the goods. That is for business purposes, it may be relevant. Some individual trader or other person may want to buy foreign currency or currency of another country for speculation purpose, in the desire that the price of another currency or a specific currency may increase. So the purpose may be different, but main thing is that the trading of foreign currencies or the trading of national currencies takes place continuously. What is the timing or what are the days? Mondays and Fridays often see relatively higher trading volume in forex market compared to other weekdays. Forex market remains open from Sunday evening to Friday evening, and the high trading volume is normally seen on Monday and Fridays in comparison to other weekdays. Though there may be variation in trading volume due to some other reasons also. While there is no single physical location in the case of forex market, there are some major financial hubs in the world which play an important role in the forex market. Which are those financial hubs? These are London, New York, Tokyo, Hong Kong. Though there may be other hubs also, we are only giving the example of few. London, New York, Tokyo, and Hong Kong. Why? Because a large number of major brokers, large banks, investment firms, known firms are located at these places. Because big banks or investment firms are located in these specific locations. So, major the trading of foreign exchange, that is the volume of transactions in the forex market, takes place in quite big numbers at that centers. This concentration of financial powerhouses results in substantial volume of forex transactions being handled within these centers. At these centers, a large volume of trading of foreign forex trading takes place in these centers. But it is not to say that these four centers represent the entire forex market of the world. The trading is continuously happening across the globe through decentralized electronic network. The foreign exchange market is a decentralized network. The transactions are happening continuously through electronically, connecting buyers and sellers around the world. Participants such as banks, investment firms, foreign exchange dealers can access forex market through online platforms from anywhere with an internet connection. Now the topic before us is understanding the foreign exchange market and its currencies. Foreign exchange market. Foreign exchange market can also be known as forex market or FX market. What is the foreign exchange market? It is the marketplace where the national currencies are traded with one another. What it means? It means that suppose our currency in India, domestic currency, Indian rupee, and we want to visit, say, USA. And what is the currency of USA? It is US dollars. So to visit USA, we may be interested to buy US dollars. It may be also possible that we want to import certain things. For that purpose also, foreign exchange or foreign currency is required, which in case of India is maybe US dollars. So forex market is the market where buying and selling of domestic currency with other currencies, or the buying and selling of national currencies takes place. It is not a specific physical place which can be regarded as foreign exchange market. It does not have a special office such as New York Stock Exchange, Bombay Stock Exchange. It is not that. Foreign exchange market, in the case of forex market, all the transactions take place online, and the participants include banks, commercial banks, central bank, investment firms, individual traders, etc. There are financial hubs which are located at different places in the world, and all these participants play a major role in this forex market. So let us read. Foreign exchange market is a global decentralized marketplace for the trading of currencies. It is the place, or it is the marketplace where participants can buy, sell, exchange and speculate on the respective value of different currencies. It may be stated that when there is interaction between the buyer and seller, and on the basis of that, exchange rate is determined. The market in which national currencies are traded with one another is known as foreign exchange market. The majority of the foreign exchange buying and selling nowadays happens online. Sometimes it may happen that only a minor share in the forex market trading takes place offline. For example, in the case of tourists visiting another country, may have banknotes of foreign currencies. For example, if someone from USA is visiting India, he may be having US dollars with him. So at airport or exchange bureau, they will exchange their US dollars with Indian currency. Indian currency in case of India is the domestic currency. So the tourists from USA will be exchanging their domestic currency with the domestic currency of India. In case of India, US dollars is the foreign currency. So if anyone travels from USA to India, he will exchange their US dollars for Indian rupee or the country which they are visiting, or they will change their currency with the domestic currency of the country where they are visiting. Now, some important points about the forex market are that it operates 24 hours a day, 5 days a week. It is not open 7 days, it is open for 5 days. From when, which are the working days? Sunday evening to Friday evening. It means that somewhere in the world there is always a market open for trading currencies. It is not that transactions happen manually. Transactions happen electronically. Buying and selling of foreign exchange happens electronically. It means that both we are having US dollars and we are living in USA, and we want to exchange it with, say, Japanese yen. So this buying and selling, US dollar is we want to sell, we want to purchase. In USA, we want to purchase Japanese yen. So this is the buying and selling. So these transactions, buying and selling, takes place electronically through computer networks. Next point is, these computer networks is a global network for the exchange of currencies. Who are the participants in this forex market? The participants in the foreign market all over the world. The forex market is not confined to any specific country. The forex market is spread throughout the world, and its participants include banks, central banks, investment funds, foreign exchange brokers, individual traders, etc. from all over the world. Currencies are traded in pairs. What it means? Suppose we are living in Russia, and we are having trades with China. Some sort of buying and selling, import and export happens in Russia and China. So if we are living in Russia, we may be exporting certain things to China. In return, China will be giving us currency. In which currency? As may be agreed by the businessmen, or in rubles, or in Chinese currency. So what happens? Sometimes we are, say, living in Russia again, then we want to visit China. So in Russia we are having the local currency, and when we will visit China, the Chinese people will not accept Russian currency. for normal sale and purchase in China. So here in China, we have to purchase the currency which is the legal tender in China. So what happens? There is exchange of currencies. One currency is being sold, that is here we are exchanging. Exchanging means one person is selling and another is purchasing. So here what is being sold? Rubles. It is the currency of Russia. And in return, we will be buying the currency of China. So here it is buying. So two currencies are involved, Russian currency and Chinese currency. So it is the pair. If we are so we are in India, our currency is Indian rupee, and we want to visit say USA. In USA, US dollar is the domestic currency. And if we want to purchase say US dollars, so we are here selling Indian rupee and buying US dollars. So again here two currencies are involved. So any foreign exchange trading involves two currencies. In the same way, euro and US dollar. So it represents the exchange rate between one currency and another. Next is how the foreign exchange rate is determined. The interactions between buyer and seller through buying and selling the foreign exchange market ultimately determine the foreign exchange rates between different currencies. Though determination of exchange rate depends on other things also, it is ultimately depends on the interaction between buyer and seller. If the buyers are more, naturally the demand will be more and the exchange rate will go up. If the demand in the market of a particular currency is less, then naturally the exchange rate or the value of the currency which is being sought, if the demand is less, the exchange rate may fall, value of the currency may fall, though temporarily. See that in the case of share market, we are having New York Stock Exchange, Bombay Stock Exchange, National Stock Exchange in India, and similarly many stock exchanges which are having a proper office, proper buildings, which are called new. This is housing the New York Stock Exchange, or this is the Bombay Stock Exchange. That is proper buildings are there. But in the case of forex market, there is no central exchange. Trades in the forex market are conducted directly between buyers and sellers, often through intermediary banks and brokers. The transactions in the foreign exchange market are not confined to only one or few foreign currencies. It means that it is not that in the foreign exchange market, say only US dollars, euro, or Japanese yen are interaction takes place. Buying and selling of these only few currencies takes place. It is not that. The currencies from all over the world are being sold and bought in the forex market continuously. Though the volume of a currency may be less in comparison to others. Forex market is a vast and dynamic marketplace. Dynamic here means that it is not that if at present say one US dollar is say 83 rupees approximately. It is not that it will remain stable. The value of one US dollars in terms of Indian rupee will remain stable. We are taking here only example. The value of the exchange rate continuously changes on the basis of demand and supply. So it is a dynamic. The rate of any currency in comparison to another currency is fluctuating every second. because the transactions are continuously taking place in the forex market. Now, what is the volume of the transactions? There is huge volume of transactions. In 2022, the average daily trading volume of the forex market was about 7.5 trillion dollars. You can see here from the figure that daily turnover of the foreign exchange market he is increasing year by year from 2010 to 2022. It is continuously increasing year by year. This means that currencies are constantly being bought and sold in the forex market. Now we will understand what are the most frequently traded currencies. That is, what are those currencies which are mostly being bought. These currencies which are mostly traded are US dollars, euro, Japanese yen, British pound, Australian dollar, and Canadian dollar. As for an estimate, only these currencies account for roughly 88% of all daily forex trading volume. We are not saying that other currencies except these are playing less role in the forex market. It is not that. There are also many other important currencies. We are here only keeping into account the most traded currencies. Chinese yuan, Indian rupee, Brazilian real, the currencies from the developing economies. These are the currencies from developing economies. Chinese yuan, Indian rupee, Brazilian real are also becoming increasingly important in the global exchange market. Thanks for watching. If you like our course, please spare some time to give a star rating to our course.